Gamer token to the moon. It will go back up. The developers have a plan.
Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
Before we get going here, if you guys want to go down into the description and download this PDF that I made so you can follow along, it has the example that we're going to run through in today's video. It also has another one in there for you to go back through and practice on your own. So one of the most important aspects of any trading plan is risk management. A crucial component of a comprehensive risk management and trading strategy is knowing how much of your capital to risk in any trade. Now, if you're actively trading, this will be the determining factor of your success, a far more important component in any trading plan than really anything else. And yes, that includes technical analysis. In your risk management plan, you should have designated a portion of your portfolio allocated to trading. For today's lesson, our trading account has a balance of $10,000. Most traders, especially new ones, stick to what's called the 1% rule. The 1% rule says that you will never risk any more than 1% of your entire trading capital on any given trade. For example, if you have $10,000 in your trading account, 1% of your entire trading account would be $100. If you're only ever risking 1%, then you can only ever lose 1%. Now, it's important to practice your strategies, both your trading strategy as well as your risk management strategy. Most exchanges do offer a testnet, so you can check out the user interface and test your strategy on a selected platform. Bybit's testnet is actually amazing. All you have to do is visit the link in the description below, sign up, then ask one of the nice support people in the chat for some testnet funds. All right, so back to position sizing. There's some info that you need to determine before looking at any trading setup. The first thing is you need to know your maximum capital risk. In this case, it's the 1% rule. So we're only risking 1% of our total account. That will be $100 for this example. Another is your acceptable risk to reward ratio. For this lesson, our minimum risk reward ratio that we need to see before entering any trade will be 3. This means that for a trade to meet our standards, the projected target must give us a return of at least 3 to 1, meaning we'll risk $100 to make $300. So say you join the free Telegram group, the link is in the description below, and you catch this Bitcoin setup that I posted on the 4-hour time frame. So what information do we know actually before we even look at the trade setup? We should know our maximum capital risk, which would be $100. And we should know our acceptable risk to reward ratio. That would be 3. Okay, so we busted out our long position tool. Our point of entry is here at $42,407. Our take profit is at $56,100. And we've determined that a safe stop loss would be right here at $38,732, which is about 8.67% from our entry price, giving us a nice risk reward ratio of 3.73. So if you're risking $100 on this trade, you stand to win 3.73 times that $100 should the trade be successful. So using the formula here, risk amount divided by stop loss will equal your position size. Let me say that again. The risk amount divided by your stop loss will give you your position size. So our risk amount is $100. divided by our stop loss, which would be 8.67% or 0.0867, gives us our position size, a position size of $1,153. You might be saying, wait, I thought we were only able to risk 1% of our account. Well, no worries, I got you guys. This is exactly why leverage can be a great tool when used responsibly. However, when used irresponsibly, it can literally wipe your entire account in a single trade. We need an extra $1,053 in margin for this trade. Now, since we're only risking $100, that means we need to borrow $1,053 from the exchange that we're using. $1,153 divided by $100 gives us 11.5. This will be the leverage for the position. But we know that we're risking 1% of our $10,000. That is $100. We're going to divide that by our stop loss, which is 0.0867 or 8.67%. That gives us a total position size of $1,153. So we need to borrow that $1,053 to be able to meet that risk reward ratio that we've predetermined before entering the trade. So we use the 11.5 X leverage. Our stop loss is 8.67% below the price at $38,732. And our take profit order is set at $56,100. A winning trade here will return $367, of course, minus exchange fees. However, a losing trade will result in a loss of $100 plus exchange fees.
Hey, that's pretty good.
Let's go ahead and review that then. Okay, so the trade setup would be to buy the breakout, giving you a 32.29% win on a breakout trade here. And we decided that it would be safe to put our stop loss down at $38,732 because we don't think price action will come back and stop us out there. So that gives us a risk reward ratio of 3.73, which is acceptable according to our risk management plan. So we go through and we calculate our position size. So we know our entry price, that's 42,367. And we know that our stop loss will be 8.67% below that price. So we divide our margin, our $100, our total risk amount, divided by 0.0867 or 8.67%. That gives us our position size of $1,153. $1,053 above our 1% risk. So all we have to do is borrow that difference using 11.5 X leverage from the exchange to meet the requirements that we have set for this trade. Now, leverage is not always necessary here. You can just as easily move your stop loss up and tweak your risk to reward ratio, but it is important to note that a tight stop loss is not always going to give you the most probable outcome for the trade that you're attempting to enter. Now, if a lot of this doesn't make sense to you, or if you still are struggling to learn technical analysis and basic risk management, we have built one of the best trading courses out there, and we are giving it away for free over the next month so you can make sure that you're ready to go when the second half of this bull run starts to pick back up. So make sure you get on over to the website 3candlecollective.com and make sure that you submit your information as soon as possible because spots are filling up pretty quickly. Guys, there's also some pretty awesome resources in here. There's a free fillable PDF TA journal, a free chart pattern journal, a free guide to using Uniswap if you're not sure how to use the decentralized exchange. There's a free portfolio tracker, which does have a position size calculator inside of it, and a simple dollar cost average strategy that did extremely well in the first leg of this bull run, turning effectively $2,200 into $14,000 over 11 months. Also, Pi is one of the coolest free ICOs there is. There's no KYC, and you earn free Pi all day long just for checking in on the app once a day. Pretty cool stuff. But that's it. That's all I got for you guys today. I really hope this lesson helps everyone out. If you have any questions, leave a comment below. I'll make sure to make another video and answer as many of them as I can. Yeah, I hope this video helped. Go ahead and join the free Telegram group. The link is in the description below. And I'll see you guys in the next video. Peace.